Hey, everybody out there. With us once again is Mark Collinsworth of Vera Global Financial Wealth Management. And today's topic is what happened with the Fed today, raising interest rates a 0.5%, and yet the stock market went up. So, Mark, explain.
Well, thank you, Larry. So basically, Wall Street was anticipating two things today. They were anticipating at the next meeting they have in June that the Federal Reserve is going to start doing 75 basis points. That question was asked to Jeremy Powell during the conference call today, and he said, no, we're not considering 75. We're just going to do 50 basis points. So that helped the market out. And then also with the quantitative easing, the Fed's actually going to start selling bonds. They were anticipating 95 billion, but they're only going to do 45 billion, which was another surprise to the plus side.
So even it was still a 0.5% rise in interest rates. I mean, shouldn't that itself have put something of a chill in the market rather than the market going up?
Well, not really. It was a surprise that the market wasn't expecting. Plus, not to mention, the market was already in oversold conditions. The market's been going down since January 1st. And just like in 2008 and 2002, markets don't go down every day. They basically get what we call relief rallies or bear market rallies. No. And I expect this rally to run out of steam here in the next few days and start back going to the downside.
Okay, so they were expecting a 50% raise, a 0.5% interest rates, and then perhaps 0.75% interest rate after that. But now, since Powell indicated that that's no longer probable, that itself was a boost for the market.
Correct. It was a pleasant surprise, but here's kind of the rub. Powell has his call, and he says that today that they're not anticipating 75 basis points at the next meeting. The Fed minutes, so all the notes they took in today's meeting, those notes get released to the public in 2 weeks from now. In 2 weeks from now, do we see where Powell is sitting there behind closed doors in the notes, and he's saying, we really need to do 75 basis points at the next meeting? What do you believe, the notes or what he says on TV?
All right, so if the notes come out and it's 75 basis points, that's 0.75% next time, in addition to the 0.5% today, will that have a chilling effect on the market?
What the market will basically do is they will sit there and say Jeremy Powell is sugarcoating something that's very important, and the market will sell off like crazy. Give you an interesting tidbit. I've actually got a chart around here. Every Federal Reserve meeting that we've had so far since August, the market has rallied up. It's actually rallied up all the way until the Fed minutes have come out 2 weeks after, and the market tops out and starts selling off, because what they say in the TV conference call, like today, does not match up with what the Federal Reserve is discussing behind closed doors.
All right, no matter the size of the hit next time around, how soon will that come, by the way, the next rise in interest rates?
The next meeting, the next Federal Reserve meeting is around the middle of June.
Okay, so not that far off. Now, no matter what it is, whether it's another 50% or 75%, that is 0.75% interest rate hike or whatever, aren't they playing kind of a delicate game here? I mean, they're trying to tamp down inflation by raising interest rates, but will that in itself not cause perhaps even more inflation, or at least a depressed market and a possible recession?
You are correct. So with inflation already being at 8%, having the Fed funds rate at 1%, 2%, or even 4% does absolutely no good, because instead of paying a higher interest rate on your mortgage or your car payment, essentially what you're doing is you're paying a higher rate of interest per se on the food and the gas that you buy. So the Fed funds rate being at 1%, 2%, 3% doesn't matter as long as the inflation rate's above that level. That kind of makes sense.
So, I mean, are they going to be able to steer this into a better course for the economy of the nation, or is it still unknown territory?
Well, this is kind of the rule of thumb with the Federal Reserve. The Federal Reserve will always raise interest rates to the point to where something breaks. If you go back through history and look at when the Fed actually starts cutting rates, they never cut interest rates when things are all happy and sunshine. Last time they cut rates, March of 2020, COVID was breaking out and the stock market was collapsing. Time before that was March of 2008. Housing bubble was starting to fall apart. Go back before that, it was the long-term capital issue and so forth and so on.
And also 2001.
2001 with 9/11, they cut interest rates then because of 9/11.
All right, so something disastrous or something traumatic has to happen before they make that kind of an adjustment.
Well, it doesn't necessarily have to be something dramatic like a 9/11. It can simply be that the Fed raises interest rates so much they actually create a recession.
Right. So, in other words, let's say like after 9/11, because of all the turmoil and all the fear of the unknown, what was next, this and that, they lowered interest rates in order to stimulate a shaky economy.
Correct. And also try to calm down the stock market, because what really drives the economy today is really the performance of the stock market, is what they refer to as the wealth effect.
Yeah. So, Mark, I mean, what's your prediction of where all this is going in the next year with these interest rates ahead, people trying to guess what they're going to be doing, fluctuations in the market? I mean, the overall pattern, up or down or about the same? What?
Well, this is kind of the take on it. Whenever the Fed says, the Fed speak, they say we're going to raise interest rates until we get demand to slow down. What they're really saying in, outside of Fed speak, is they're saying they're going to raise interest rates to the point that people start losing their jobs, because once you lose your job, demand goes down. So I expect the economy to get worse. I expect the stock market to be worse. And then there'll be a certain point in there when the Fed or President Biden says, I just can't handle this economy anymore, the Fed will step in and start cutting interest rates.
Well, that sounds like we're heading into a recession, are we?
The odds of us going into a recession are actually increasing every single day. The GDP numbers for first quarter actually came out as negative. If we have a second quarter of negative GDP, by textbook definition, 2 negative quarters back to back of GDP is a textbook definition of recession.
But you don't believe if there is a recession that it will be severe.
I don't believe this one will be severe. And the reason why is because the Fed still has a lot of buying power on its balance sheet. With the COVID and all this stuff, I think they expanded by what, $4 trillion, $5 trillion. They could easily pump in, since you can print unlimited amounts of money, technically, they could go and print 50, 60, $70 trillion worth of money, fiat currency, buy bonds, maybe even buy stocks to try to stop the stock market from declining. So they still have a lot of ammunition, or even taking interest rates negative, by the way. They can make a negative interest rate policy like Germany has.
So what I'm gathering from all this as a layman is that it's still pretty much unknown where we're headed in the next year economically, although chances are increasing that there will be a slowdown and possibly a recession.
Correct. I think we'll get a slowdown, might even turn into a recession, but I believe, as always, the Federal Reserve will probably hit the panic button. They'll cut interest rates again. They'll start their quantitative easing program, where they go in and buy mortgages to drive down mortgage rates to spur home buying. And I believe that will set us up for the second great leg of the bull market. And of course, the Fed will keep on pumping money into it, just like they did in the 1920s, until it reaches critical mass. And then once it reaches critical mass, just like it did in 1929, after that point, no matter what the Fed does, it's just a downhill slope all the way.
So we're seeing a cycle here, it's a down, up and down, and then perhaps another crash. So overall, for investors out there wondering how they should navigate this, and you're a financial advisor by profession, what's your advice to people out there?
I would say right now, if you're overweight, if you own a whole lot of stocks, especially tech stocks do not do well in a rising interest rate environment. Get rid of your tech stocks. Yeah, I know they've done really well over the last 5 years, but just because they did well over the last 5 years doesn't mean they're going to do well over the next 5 years going forward. Look at hold some cash in your portfolio, because there'll be a better buying opportunity later this year. Between now and then, own stuff like the stuff that people have to use. Consumer staples, food stocks, things of that nature. People still have to eat no matter how bad the economy gets. And then once the market bottoms out here towards the end of the year, get back in the market and ride that up until we reach critical mass, which will be in another, 7, 8, 9 years down the road by my estimates. And by that point, it'll be game over.
Okay, but now, well, what do you mean by game over? Elaborate on that.
Well, okay, well, so I'll get a little interested. So William Gann, back in 1908, he studied the stock market history quite a bit. And he basically, after studying history over economies going back hundreds and hundreds of years, he discovered that there's a 100-year cycle that goes through the stock market. Okay. The reason why he started working on this in 1908 was because of the financial panic in 1908, where the bottom fell out of the stock market and made the 100-year bear market in the future in 2008 look like a kindergarten picnic. 100 years, 1908, 2008, you kind of see the pattern there. But let's take it one step further. If William Gann was alive today and you told him, hey, this COVID stuff broke out in the economy in 2019, we started actually identifying it in 2020, he would say, that's not a coincidence. Why? Because Spanish flu broke out in 1919. If you ask William Gann, hey, what about what do you think about 1860, the 1860s and the 1960s? What do you have that in that 100-year span? You had a president assassinated in the 1860s, had a president assassinated in the 1960s. You had a civil war to basically bring civil rights to African Americans. What'd you have in the 1960s? You had the Vietnam War and you had the civil rights movement. So therefore, add 100 years to 1930, and where does that put you?
2030.
Yep.
So by 2030, you're saying that the bottom is going to fall out.
I think based on that 100-year cycle, come basically, 2000. I think the 2030s will have a whole lot more in common with the 1930s than they did with the last 10 years.
Wow. All right, let's go to another topic here related to the economy. You might have caught the president today making a speech of how his administration in his first year has cut the federal deficit significantly and will cut it even more significantly next year. True or false?
I am going to go with that's a hard false. And the reason why is because, as you probably remember, back here earlier in the year when they were the Democrats were trying really hard to pass additional stimulus money, and there were some Democrat senators said, hey, we're not voting for any additional spending because of inflation. That additional spending that didn't get voted for, the money had already been allocated. So the money was already sitting there in the Treasury Department for them to tap into. But because they didn't spend it, that money's now sitting there for them to apply to this year. Give you a more direct example. Let's say you go to the bank and you borrow $100 over. So your $100 is growing in loans that you get from the bank. You go to the bank and say, hey, because of all this COVID problems, I'm not really sure how much money I'm going to need. I need to borrow $200 this year. But you only end up spending $150 of it. You now have $50 in savings from your original loan of $200. Next year, you go to the bank and say, hey, I don't need the $100 this year. I only need to borrow $90, which technically 90 and the 50 you still have in savings from the loan from the previous year, you technically are borrowing $140, which is a 40% increase from what you were historically borrowing from the bank, if that kind of makes sense.
Well, the trick there is that Biden is not counting what was left over from before.
Either he's not counting it, or he's just doing it for optics to say, hey, look how great of a job I'm doing. I'm like the first president in like 20 years that has actually caused the deficit to go down. Well, no, he just simply didn't spend all the money that he had in his pocket.
He also mentioned that his predecessor, although he doesn't name him, he never names Trump, his predecessor, did the opposite, raised the deficit. Is that true?
The deficit under Trump, the deficit was still expanding, but it was starting to slow down. As you probably remember, the economy was starting to do really well. The stock market was doing really well, but then COVID hit, and that basically, the best laid plans fell apart. But if Mr. Biden really wants to talk about predecessors, the predecessor before Donald Trump actually accumulated more debt in his 8 years of being president than all the previous presidents from George Washington up to that moment had ever accumulated.
And that, of course, is Barack Obama.
But you said it, I didn't.
So, all right. So Obama created more of a deficit than so many presidents before. So, but then Trump came along and added to it. Did he not?
Correct. But this kind of thing, if let's say I'm president, let's say I'm in Barack Obama's shoes. I run up trillions and trillions of dollars of debt, and you're having to pay hundreds and hundreds of billions of dollars on that. And you've got to borrow that money to pay. You have to borrow more money to pay the interest on that. When you take over office from me, if you have to basically increase the deficit to simply meet the interest payments on the debt of your predecessor, technically, did you really expand the deficit, or are you just trying to clean up the mess from the guy before you?
So you're saying that's largely what happened.
That's largely what happened. Yes.
On the debt that Obama built up.
Yeah. The debt explosion, like I said, under Obama, if you take every president from George Washington up to Barack Obama coming into office, he accumulated more debt in his 8 years than had been accumulated in 200 years of U.S. history.
Yeah. Well, it's in terms of Biden trying to at least stabilize the economy, let alone improve it before the midterms. How probable or even possible is that?
To stabilize, I don't think there's really much of a chance of stabilizing it. One, you still have the inflation problem, which doesn't look like it's going to get better. I figure inflation is going to get worse as we always move into summer travel season. Gas prices go up, more people travel, more demand for gasoline. Second thing is the Federal Reserve is raising interest rates. It normally takes once the Fed raises interest rates, it takes about 4 to 5, maybe 6 months for those interest rate hikes to actually work their way into the economy and you really start feeling that punch. Well, basically you go out, 5 months from now, you're basically hitting right in the middle of the midterm elections.
Yeah. So gas your comment on gas prices perked me up just now. So summer driving is going to raise gas prices even higher than they already are.
That's correct, just simply because of the increased demand from traveling.
Something to look forward to.
It is always.
All right. Mark Collinsworth of Very Global Financial Wealth Management. Thanks for this session, and interesting to see how this is all going to play out. It's like a new surprise every day. So we'll keep following it. And thanks once again for being with us. And thank all of you out there for being with us once again. See you soon.
Yep. Thank you.